Hello, hello, hello. Welcome back to Bitcoin News Live. We got a great show ahead of us today to answering the most pivotal question on our minds right now. Has Bitcoin bottomed? We got an expert who's going to dive into all the charts, show us data that you've never seen before, and make sure that you are up to date as to what is going on the Bitcoin blockchain. All right, let's get into it. Bitcoin is down more than 50% from its all-time high, and the market is split into two camps. One says the real pain is only just beginning. You can hear them chanting in the background, one more leg down, one more leg down. The other says the bottom is quietly forming right now, buried in on-chain data that most people never bother to read. Our guest today lives inside of this data. His background ranges from flying long-haul aircraft to studying particle physics. He has built one of the most followed on-chain analytics platforms in all of Bitcoin. This man reads the Bitcoin ledger like an X-ray into the psychology of millions of market participants. So we are going to put the only question that matters straight to him. Has Bitcoin finally bottomed? All right, I'd like to bring up our guest today. We've got Tom, aka On-Chain Mind. Sir, how you doing today?
Yeah, I'm doing great. I mean, that was probably the best intro I've ever had. So very much appreciate that. Thank you.
Let's go, man. Yeah, no, you've got a fascinating background. You fly around the world, you've studied particle physics, and you've got one of the cleanest, best looking Bitcoin analytics sites on the internet. So let's dive a little bit into your background. Tell us everything from particle physics, being to Bitcoin for over a decade, being an on-chain for 7 years or so. Tell us everything.
Yeah. So as you said, particle physics, that was my degree. Pretty hard degree. It was all about the data, all about diving into, the uncertainty of the world, which is kind of has a lot of parallels with Bitcoin itself, especially on-chain analytics. Then, moved into flying, like you said. That's what I still do as a day job. I fortunately have enough time on my hands, more time than the average person, as you could probably tell, to dive into the data more than other people. So yeah, I spend most of my time working on this sort of stuff. I appreciate your comments on the platform. The idea really is just to make data accessible. All of this data is quite complex. You can look at it and just get pretty overwhelmed pretty quickly. So the idea with the platform is to kind of just make it accessible. A chart that speaks 1,000 words. I just want it to be, read easily. So that's the goal right now.
Yeah, it's beautiful stuff. And I think one of the best things that on-chain data does is it gives you perspective, right? We on Bitcoin Twitter, on the internet, we can get in over our skis. Of course, when things are going up, there's lots of euphoria. When things are going down, it's the end of the world. Bitcoin's never going to recover. But if you're able to look at the charts, at the data, you can see signs for they don't tell you exactly where we are, but they're signposts as to how far along we are. Okay, so the question right now on top of everybody's mind, have we bottomed yet?
Well, it's the ultimate question, and there's nothing that I'm going to tell you today that will tell you definitively. Even on chain won't tell you that, but we can get pretty close with it. If we pop onto some charts here, if you like, and we can have a quick look.
Please. I'll bring it up on stage here. Nice.
Now, can you see everything all right here?
Yep, perfect.
So this is a pretty popular chart on the platform here. And at first glance, you might just be thinking, well, what the hell is this telling me here? It's just a load of peaks and troughs. Well, this is one of the most famous charts in Bitcoin on-chain analysis, and it's called the hodl waves, more specifically, the realized cap hodl waves. And what you can see here is that I've isolated something called short-term holders. Now, in Bitcoin, there's two major camps that you can kind of fall into as an investor. You can either be a short-term holder or a long-term holder. And that boundary is split by about 155 days, which is about 5 months. So it's not as long as you might think. But when you look at that boundary, you can see that your probability of spending your Bitcoin and just acting rationally in general starts to go up exponentially. Now, what we've got here is the short-term holders, so the younger money, and how much of the market they represent. So essentially, how much of the Bitcoin network has been invested by short-term holders. Now, you can see pretty clearly on the chart what the things that jump out here. The massive waves or the spikes in this metric occur pretty much at the price peaks of all the cycles, of diminishing severity, sure, but they're pretty distinguishable. And that's because at price peaks, that's when everybody's flooding into the market. All your friends are messaging you saying, is this the top? Should I get into Bitcoin right now? And just everybody's coming in en masse. And that's what this is showing here. When we're getting towards 80%, this means that 80% of the entire invested network on Bitcoin is held by this younger capital. But the reverse is true as well. When this drops off a cliff completely and dives into these wells here, that's when the short-term capital has completely been purged out of the market. Whether that is there just is not enough capital coming in, or people have sat and bought the top and have now aged past that 5-month mark into the long-term holder cohort. And that's a bit of a nuance there. But what we can see here is that every time this has dipped down into this well, we've again marked the bottom here. You can see in every prior cycle, when the short-term holders have exited the market, that has been the best entry opportunities for the next 3 or 4 years. And what you can see here is that we are now dipping into that well. So we've had an absolute monumental sell-off from, the peak in about February time is when this really started dropping off a cliff. And right now it's just on an absolute free fall to this bottom well. And it doesn't look like it's turning around anytime soon. This is kind of where I'm sort of throwing out caution, saying, trying to call today as being the bottom is pretty hard. You kind of want to see this metric start to curl over a bit. The bottom in terms of mass capitulation is in, and now people are maybe starting to think, oh, maybe I do want to get back into Bitcoin, and that's what we're going to looking out for here. So we're getting really close to that in terms of percentages here. We're at the absolute lows in terms of short-term holder speculation, but have we made that turn yet? Well, that's to be confirmed yet.
One thing that's very glaring about this chart is that the young money was nowhere to be found this whole cycle. They didn't show up at $126,000. What's your insight on that?
Yeah, it was a bit of a different cycle, really. There's been a lot of speculation about, well, why didn't we get that euphoria? And, that we've seen in every prior cycle, in 2017, 2021, and the early Bitcoin years, we had those absolute parabolic runs up. And that's what draws in the short-term capital, because they get excited by price. And yeah, don't get me wrong, we've had a pretty monumental run up from the bottom at around 16,000 to 126,000. That's a pretty good increase, but it was done in a steady way. So we kind of had this, like you can see here, 3-wave run up. So instead of one big parabolic run up, we've had just 3 mini waves on the way up. So it's an interesting dynamic, and whether that plays out differently for the bear market, then we can only speculate on that. My guess is that the bull market that we just had will likely author the bear market that comes. And that's something that Checkmate, who's another amazing on-chain analysis in this space, talks about. Maybe the fact that we didn't get euphoria means that we don't bottom in such an extreme way as well, and that we might just bottom in a sort of apathetic way, in the sense that we might just be bored out of the market before it goes again.
Yeah, that makes a lot of sense. And looking at these 3 humps in the last cycle, we had the all-time high that came prior to the halving, right? So that was the early 72,000 all-time high, I believe, in March of 24, right? And then we had the Trump election euphoria. And then does this last peak here, does that coincide after 126? It sort of looks like that last peak with new money came in maybe early 2026 rather than end of 25.
Yeah, absolutely. So you're absolutely correct. This $126,000 actually came at a time. Oh, sorry. It actually came at a time when there was short-term capital like exiting the market, or it was creeping back up slightly, but it definitely wasn't at a peak of that. And that was another telltale sign that we've hit another price peak, but it's kind of not coming with the same rigor and force that it has before. These previous 2 peaks, while not as big as all the other ones in the past, they did come pretty fast and powerfully. But this one here just didn't. And that was kind of a little bit of a warning sign that maybe things aren't quite as strong as we thought they were going to be.
Mm-hmm. And another number I want to dive in with you is that 155-day mark that delineates between short-term money and long-term money. When you say 155 days to a lot of Bitcoiners, they're like, what are you talking about? Like, anybody under 3-4 years is a short-term holder. Like, they're not getting the full point here. So where do you guys come up with this 155 number?
Yeah, so this research was done by Glassnode, which is probably the biggest on-chain analytics platform out there. And this was done, I think it was around 2019, 2020 sort of time. It was definitely during the last cycle where they modeled it all out. And that was the number they came to. I believe it was, and don't quote me on this, but I think it was the chance of spending within 14 days was at 3%. Now, basically, it means that at what point on the curve did spending just drop off a cliff? The chances of someone spending within the next 2 weeks. Now, that was true for back then. There's been a lot of sort of debate since then about, is that still true now? Does it fluctuate? One of my good friends and colleagues, Matt from Bitcoin Magazine Pro, he actually did some pretty good research recently modeling how that changed over time, because this 155-day threshold is not, it's not a fixed number in time. It actually fluctuates. And right now, I believe it's actually more than that. So meaning to be qualified for a long-term holder today, it's actually slightly more than that number. And it does fluctuate between about 100 to 200 days. So again, it's not a terrible amount of time, really. You know, I think most OGs would agree with you that, you know, you've got to be around at least a couple of cycles before you can call yourself a long-term holder. But in terms of rational behavior, that's pretty much exactly where it falls.
Yeah, short-term time preference and long-term time preference definitely shows different personality traits, I guess you could say.
Yes.
So, what other charts do you have for us?
Yeah, well, in terms of Bitcoin bottoming, I mean, you know, this is just one chart here. We've got the hodl waves, which is pretty powerful. My whole goal was to try and use a whole different level of confluence. So not just on chain, but technical, macro, and all sorts of different indicators to try and give me an overall risk score. So what I've got here is something that I've had on my platform for a very long time now, and it's called the Omega score. And basically what it does is it takes all the technical on-chain and macro indicators that I really care about in terms of cyclical behavior and scores them into a 0 to 100 risk score. And then for simplicity, we're going to plot it as a heat map here onto the price chart to kind of see where we are in the market cycle. Not for absolutely time in the top and bottom, but for giving us an overall indication of where it might be good to DCA, where it might be good to sort of turn off our DCA. You know, you don't have to be precise and perfect. What we can see here is that we've been hitting some pretty extended blue territory here, which for in blue in this term is about bottom terms. So right now we're actually at about 10% on the risk score. So between 0 and 100%, it's pretty good bottom territory. And if we sort of isolate that for itself here, so this is below 10% on this risk score. Now, how I like to play this is I don't like to time the absolute bottom. Like I'm not looking for 57K and going, right, that's the bottom, I'm going all in, because all models will break at some point and we'll all be wrong at some point for sure. So what I like to do is to turn on my DCA more aggressively when we get to lower risk scores. And we can see that's worked pretty well here on across every cycle here, turning your DCA on at these bottom sort of signals here. And this is where the on-chain levels, the technical levels, all of these levels are extremely depressed and where the best long-term risk reward has come. And right now we're in that zone. We had our deepest retracement to about 6% on that massive sell-off down to just below 60,000. And then again, we're kind of entering that zone again. But what we can see here is that this zone kind of happens for longer than you would expect. You'd think it would be one big flush out and then off we go again. But we can see that's actually not the case. We do flush down to those depressed levels, but then we do end up spending about, 3 to 6 months down there chopping around. Price doesn't just immediately V-shape recover. So for me, I'm not going all in at these levels, but I'm absolutely turning the DCA on at these levels. And yeah.
And do you study that, or do you have any metrics on your site about DCA and going more aggressive at times when it is in this blue zone versus not? And have you modeled that out as to, well, we lost him for a sec. I think he'll come right back in. It's probably just changing that. But I mean, this guy, he's got amazing charts. And as you can see, he's very level-headed and knows what he's talking about. In terms of Bitcoin right now, we are at $65,348. We are experiencing quite a relief rally, as some might say, or is it the beginning of a new bull market? All right, we got the man back on stage here. There he is.
Apologize about that. I think some connection issues there.
No worries, no worries. But yeah, just the question I had for you was whether do you fine tune your DCA like that based off of the metrics that you have on your site?
Yeah, absolutely. I don't have a hard and fast rule, but I tend to DCA below the true market mean, which is basically the average cost basis of the active investor. I don't actually have this chart up with me. I can grab it up in a second.
Cool.
But essentially, it sort of trades in between. It's kind of like the perfect moving average of the market, and that's a very simple way of looking at it. But essentially, it's the average cost basis of the active investor. So when we're below that price, it basically means that the average recent active investor is sitting in a loss, and that's where I like to turn the DCA on. And then once we get into these low risk score levels on the Omega score, that's where I like to ramp it up. And I don't really put a number on it, like I have to be 2 times DCA or 3 times DCA. I'm just increasing it slightly the lower we go down. But we can model what that actually, turns out into by looking at this chart here. Now, this might look a bit confusing at first, but essentially what you've got on the left-hand side here
I'm
is
sorry.
you've got
Could you share it one more time?
Oh, sorry.
Here we are. Beautiful.
Okay, cool. So what we've got here, these are the different color levels of the Omega risk score here. So we've got the deep blue right at the bottom, which is the extreme accumulation, versus all the way to the top of extreme euphoria, which is, the red colors. And what we can see here is that we're currently in the extreme accumulation band. And what this bottom bit of the axis says is what is the 12-month forward return for that Omega score? And this is kind of how I best like to think about it. What you can see here is the range of outcomes across all of Bitcoin's history and what it's done in the following 12 months, which is not a long period of time. And what we can see is that actually buying here has produced the least downside risk, if that makes sense. You can see here that very rarely when buying at these levels, you've sustained another 50% drawdown. So, if we're at 60 odd thousand today, then the chances of us going to 30,000 is basically unprecedented at these levels. But on the flip side, expecting, a 400 or 500% return over the next 12 months is also unrealistic. So I like to frame it like this. This is a good time to be DCAing based on your downside risk. But in terms of forward returns, you really want to increase your time horizon here. And nothing illustrates that better than the bit below here, which basically says after 24 months, the chances of being in a positive return is 98%, with the medium outcome being a 350% return. So right now, it's all about limiting downside risk, and that's exactly what we're doing. And if you want to get the best return from that, you then want to hold for at least another year after this. That's kind of how I like to think about it.
No, this is a brilliant chart. I've never seen one like it. How do you come up with charts like this and displaying the information in new and unique ways?
I do a lot of time of just looking at this Omega score chart and going, well, how can that better serve me? How can that give me more useful information? Because like you said, you asked a really interesting question saying, but what are you doing with it? That might be quite a good idea for how I now scale into my DCA allocations. It's not something I really thought about. I'm kind of looking at these charts and going, okay, but how can I better interpret that? How can I be more sure that what I'm doing is the right thing? So, I do spend a lot, probably more time than I should, thinking about, is this the right decision to be making right now? So that's how I came up with this one here. It's all well and good saying I'm buying at low risk levels, in this sense, but what is that actually going to do to the outcome? And this is what it shows.
Yeah, and I'm over here like a caveman, just DCAing the same amount every single day, no matter what, whether it's we're up, we're down, who cares? I'm just blindly buying Bitcoin on a daily basis because that's just what you do if you want to set it and forget it. Whereas you got market experts over here knowing when exactly to fine tune that DCA, to turn the knobs up and down.
I tell you what, though, just steady flat DCA is incredibly powerful. Like when building this platform, I have tested so many different strategies. We've got a few strategies on there that we have that beat buy and hold and DCA. But I tell you what, I would say easily 90% of the strategies that I test that try to be a little bit clever in the market don't beat DCA, which is wild. You might think that, you might hear this online that every trader, it's so easy to beat DCA. It's actually incredibly hard in an asset like Bitcoin. In other assets, it's, it might be slightly easier, but in Bitcoin, it's so hard to beat a steady, consistent DCA. And I would recommend that for everyone. You don't even need to be clever about your DCA. If you've got some, a steady buy every day or every week going on in the background, then you're going to compound your wealth historically at about 30% per year. So, it's hard to beat that.
And why is it better to study DCA Bitcoin compared to other assets? Just because the CAGR is so high, or what exactly?
Yeah, it's so volatile that
Mm.
trying to model what it's going to do next is pretty hard. You look at an S&P 500 chart, and of course you have some 30% crashes here and there, but overall it's an extremely steady asset that just buying when it hits those crashes increases your compound return dramatically, and it's quite easy to trade and model that. With Bitcoin, the swings are so violent on a 12-month basis that trying to be clever about timing your buys, if you look back to some of these previous charts here, you might be so tempted to buy on that first wick down and go start going all in and being a bit clever, only for then to have another 50% drawdown, which completely alters your forward returns. So yeah, it's an incredibly hard asset, should I say, to just beat on a steady basis.
And you've been looking at on-chain data for 6, 7 years, I believe you said. What was the most fun time for you to be diving into the charts and the data and exploring the Bitcoin blockchain?
Yeah, no, well, no doubt it was. I would have to say it was around the 2020 to 2021 top, which was our last true bout of euphoria, and that was really still in its infancy of on-chain analytics. They had only some of the most basic metrics, but that was the time when everyone was building. So like, I'm not going to lie to everyone here. Like, I missed quite a lot of this. There was a massive euphoric peak at around 30,000, which I scaled quite heavily out of, only for them price to hit $60,000. So that was an incredibly interesting time. And then the bear market that followed, I did so much building. Lots of other guys have done so much building. We now understand the space so much better and can model it so much better. But yeah, certainly that time, because everything was just moving so fast. I'm sure you can remember that time back then.
Yeah, it was, and it was fun. The memes were ripping. Everybody was in great spirits. Have fun staying poor was the motto of the time, and things have definitely changed, and people are getting bored now. But what are some of the big differences between studying on chain back then compared to now? Like, what new insights have you guys discovered?
Well, okay, so the backbone of on-chain analysis, there's two metrics that if you've spent any time studying it or listening to it, that you might have heard of, and that's the MVRV, which is the market value to realized value, which essentially, it sounds complicated, but it just takes the average cost basis of the average Bitcoin holder and just sees how much unrealized profit or unrealized loss is the average holder in. And then its sister metric, which is called SOPR, SOPR, which is the spent output profit ratio. Again, another horrendously complicated name, but again, that just means that how much profit are people realizing on an average basis. And these were the two metrics that everyone was paying attention to the last cycle, in 2020 and 2021, because that was kind of when they were first becoming popular. Since then, we've got all sorts of swaths of on-chain data, which existed back then, but is not as popular now. We've got things like the sell-side risk ratio, which is kind of what I call the boring indicator, which looks like how much realized profit and how much realized loss we have compared to the market cap. There's lots of like volatility and market cap adjusted metrics that just didn't really exist back then, that are becoming so much more popular now, and that's what we're trying to incorporate into the likes of the Omega score. And the longer this goes on and the more the market cycles evolve, the more these indicators can develop, and be refined. We're still very, very early in this space.
So then let's bring up that grandfather of charts, the MVRV, if you have it. Would love to
Yes, I have.
discuss that.
Okay, well, I've got one here actually, which is pretty much telling the same story. So this is the long-term holder MVRV. So again, just to recap, MVRV means how much unrealized profit is this certain cohort feeling, or unrealized loss. And the long-term holders, like we said, these are the coins longer than 5 months that have been held for. And this one's here is normalized, so between 0% and 100% again, versus its own history. And what we can see here, anytime it's above this dashed line, it means that long-term holders are in profit, and anytime it's below this dash line, it means long-term holders on average are in a loss compared to their own history. And you can see it's been incredibly powerful across these cycles from the early Bitcoin days all the way to where we are now. We didn't experience that extreme euphoria. Like we said, we got up to sort of 75-80% on these levels, meaning that long-term holders were, experiencing high unrealized profit levels, which was kind of a bit of a warning sign, especially on this $100,000 peak run up here. If you're how I like to play things is I DCA in. I also like to DCA out as well, because we can't guarantee that we're going to experience this perfect 2017 cycle style of euphoria where we go, there's the top, off we go. So this level here, you're starting to creep above 60-70%. It's a good time to start DCAing out. And again, this is, happens on the flip side as well. We've got the lower levels here, which has been hit pretty consistently. And this is where I sort of like come to take a pause. We can see right now, we're actually at about 20% on the historical percentile for the long-term holders, meaning that we haven't quite experienced the level of unrealized losses that long-term holders hold to mark the cycle bottom. And that is that we don't have to hit that. We saw that, on this cycle here, we didn't experience the extreme euphoria of that unrealized profit at the top, so we might not hit it at the bottom. But again, it's something to pause at and go, actually, should we be going all in here? Well, I would say probably not.
Interesting. And one thing I want to ask about this chart is, why wasn't there another peak at the all-time high of 126 in terms of the MVRV here?
So it's all about that the holder base is constantly evolving. So it's not the same long-term holders that were there prior 6 months ago. The whole base is continually evolving. And that's true right now. So actually, when you look at it, a lot of the long-term holders that is in the cohort today is actually guys that have bought the top at 126,000. If you look back to about 6 months ago, it's towards the end of last year, the beginning of this year. These are the guys that have, bought at higher prices and now just held long enough, and they've just bought the bag and held the top. And, they're now evolving into that cohort. So this cohort is constantly evolving. It's not always the same bag of guys that have been in Bitcoin for 10 years, although a lot of those are still in there.
And what was absolutely amazing about this last cycle is that I believe I heard you say 10 million coins changed hands over this last cycle.
I don't have that. I don't have that number on me, but I might have said that in one of my videos. But there was a significant amount of coins that have changed hands, and but that's very normal. Not the 10 million, because obviously the supply keeps evolving over time. But you'd be surprised at how much changeover happens on a daily basis, never mind on a cycle top sort of basis. There's a lot of distribution that happens every single cycle. And that was the story for this cycle. The story of this cycle was long-term holders were offloading even during this sort of apathetic price action. And that was one of the big canaries in the coal mine of this cycle. It was like, okay, we haven't got the euphoria, but there's a lot of old money that is selling to new money. And that was kind of one of the signals I was looking at, going, what, this might not have legs.
And what do you think it was? Just the psychological marker of 100K that really instigated the OGs to cash out?
Yeah, absolutely. I think, the 100K mark was always going to be an absolutely huge, milestone for Bitcoin, just like 1 million will be in a matter of years' time. Once we hit those major psychological levels, it was the same that happened at 10,000. $10,000 was spoken about so much. And when it happened, we had the same situation play out. So, 100,000 was always going to be the sell-off, and that's what we saw. But then that third rally towards 126 just didn't bring in the same amount of capital, that short-term holder capital, and you saw that with the realized cap hodl waves, that that speculative capital, which is what drives the new price action, just didn't re-enter, and the old money was distributing to that very little cohort of short-term holders that were there, and that kind of marked the apathetic end to the cycle.
And that brings me to the question of the 4-year cycle.
Do
you believe in it? Is it all just woo-woo? What is going on here? And why is this cycle replicating 2018 and 2022 so perfectly right now?
It's one of those ones where, like, I'm I'm pretty vocal on I'm not a 4-year cycler. But I don't judge people for believing in the 4-year cycle because it's worked. But I think people's reasoning behind why it's worked is slightly misjudged. There's so many factors that go into the Bitcoin price action. Like it's all about how investors are feeling. That's the whole principle of on-chain dynamics. And the macro plays an absolutely huge part. Like, would we have got the $100,000 rally if it wasn't for the Trump election and all the different macro factors at play? Every single cycle has been completely different to the last one. 2017 was completely retail euphoria fueled. Then we had a 2019 mini cycle, which some people believe was a cycle, some people don't believe was a cycle. And then we had the COVID stimulus into the 21 cycle. Would we have got that same level of euphoria if it wasn't for COVID and the resulting stimulus from that? There's so many factors at play, is what I'm trying to say, that I struggle to believe that following the calendar or revolutions around the sun has any sort of impact on the Bitcoin market. I know that sounds a bit facetious, but that's kind of how I see it. And when you look at the cycle charts here, there's so many different ways that you can skin the cat. You can go from top to top, you can go from bottom to bottom, or halving to halving. And I'm sure there'll be someone in the comments that says, well, it has to be bottom to bottom, or they have their own opinion on why it should be the certain way. But there's no law of physics. Coming back to the physics point, there's no law of physics that dictates that it has to be that way. And when you look at these different methods, this one here, I've got top to bottom, for instance. The last two cycles, they have coincided around the year mark of the Bitcoin bear market, which is, you could start to draw some conclusions there. Maybe a Bitcoin bear market lasts a year. The one before that was 406 days, which isn't near a year. And also there was mini bear market rallies within there, which you could call mini cycles. And then the one that's conveniently forgot about is the first cycle, which this one just lasted half a year in its bear market. And the reverse is true as well. When you look at the bull markets themselves, here I'm measuring the relative low to the relative high. And the past three cycles, again, if you draw the same conclusion, have been eerily consistent. They've been about 1,050 days. But let's conveniently forget about the first two cycles, which were 325 days and 747 days. And that's me being kind there, because there was actually there was a double top. So you could easily draw that top from there. So yeah, there's some things and some models which generate a lot of heat, like the power law model. I'm kind of power law agnostic. You can fit it and it kind of works. But the 4-year cycle, I think there's so many other factors at play. You've got the halving, you've got liquidity cycles. I just can't say that it's going to follow a 4-year cycle into infinity. It's just not.
Yeah, I agree. Like, it doesn't make sense on money in many ways, but at the same time, especially with the last two, with 2018 and 2022, it's just the dates are almost lining up perfectly, and it blows your mind. And so, I mean, that's what leads many people to say we've got one more leg down, right? We got to look out for October. So, how do you reckon that with also what you're seeing in the macro environment, and how does Bitcoin play with that?
Yeah, I think you brought up a really good point, is that a lot of people are looking at this, and a lot of people aren't looking at on-chain and a lot of deep data, but a lot of people that are in Bitcoin know about the 4-year cycle. And there's something I talked about recently, which is the role of the self-fulfilling prophecy with all of this. So I really do think that actually does play a massive factor. The fact that we've had such consistent bottom to top cycles, as we can see here, in the previous three cycles, actually probably does play a factor. And the fact that everyone is looking for that magical October bottom date, I think it does genuinely influence the outcome. But having said that, the macro does play an absolutely huge factor right now. And I think that's probably the biggest elephant in the room right now. Obviously, I don't want to talk about it too much, but everything going on with the US and Iran, that could completely shake all markets at a moment's notice. And also, you've got to look at the AI bubble. I call it a bubble, the AI rally as such. But if that bubble bursts, then don't tell me that Bitcoin isn't going to sell off with the rest of it. If the stock market takes a 30 or even 40% drawdown, which isn't totally off the cards, Bitcoin isn't going to sit there fat, dumb, and happy and go, well, let's go push to all-time highs again. So yeah, I think that we've got to take it with a pinch of salt and a bit of caution, that Well, I think it's very much in play that we could bottom in October, like the four-year prophecy extends, and I think it's very much the case that it could happen. I'm not betting the farm on it because there's so much macro uncertainty out there right now, but I'm wondering to hear what your take is on that.
Yeah, I don't have my hopes up that we've completely bottomed yet. I think that we could get another big flush probably into the 50s, and that would scare everybody. And that would just, it's also the time amount. We need more time in this range. And it's just so funny because predicting by the last 2 4-year cycles, we are in the back half of July and we have a relief rally, right? And if we look at the charts, we usually have weakness in August and September, and then maybe a flush in October. But October and November, November is a great month for Bitcoin. So maybe after it flushes down, that gives us room to really bounce back up and go hard into 2027. Do you think that if there was a sell-off in the AI bubble, the capital would find its way into Bitcoin?
I think it really depends on how the sell-off manifests itself.
Mm.
You know, if it's a slow rotation, then absolutely. But if it's a market-wide panic, then absolutely not. I don't think, as much as I would like it to be the case, I don't think Bitcoin is the flight to safety that we all think it is. You know, we're in a bit of an echo chamber here where we think Bitcoin is safety, and you know, over the long term, I can only see Bitcoin coming out on top. I just don't think that's the case. It still trades like a risk-on asset. It doesn't trade like gold does, even though gold actually sells off quite a lot during risk-off environments. I think once that happens, or if that happens, Bitcoin will go tumbling down with it. It won't be forever, you know, because like we saw in COVID, everything dropped together and off we went again to the races. We haven't seen, you know, a dot-com style crash from the stock market yet. So we really, as in when Bitcoin was around, so we really don't know how it's going to react. But my sort of guess, if I had to put some money on it, is that it will definitely sell off with it in the short term. But in the long term, yeah, I hope that more money does rotate into it, because that's the kind of thing that we're missing right now.
I mean, and that's sort of my thesis. I think that we probably will see a crack in this AI bubble come the fall, as we see most stock market crashes happen in October or so. And then I think Bitcoin will probably fall too, but then be the fastest horse after that. Let's talk about gold and the relationship with Bitcoin and gold. Have you looked into that at all and charted that?
Yeah. Well, I don't have any charts up on me right now, but
Mhm.
the Bitcoin gold relationship is kind of, it's a really interesting one to sort of measure your actual wealth against, because, and it's something that I like to look at, because as we know, the fiat currency debasement is just it's gonna go on into infinity right now, and that's the whole play on Bitcoin. So measuring your wealth in dollar terms is great over the long term, but you've got to think about, you know, what's that actually going to buy me in the long term. So measuring your wealth in Bitcoin terms relative to gold has been a really powerful way. I've not really studied the relationship between rotating between the two assets. I mean, I have looked at it a bit, but there's no sort of clean correlation that I can find so far that allows a good rotation between the two. I do like to keep a bit of gold in the portfolio because, you know, it's the same sort of thesis behind it as it is with Bitcoin. You know, it's a hedge against all the rubbish that we see in the world. So I do like to have a bit of gold in my portfolio, but I don't really trade it between Bitcoin and gold as such. I'm wondering how you deal with that yourself.
Yeah, well, I got hard money pilled back in during the great financial crisis, right? 2008, 2009. And that was before I had any idea what Bitcoin was. And I thought that gold was the answer. We were going to go back to hard money after America experienced hyperinflation in the 2010s. Well, that did not happen. And gold wound up having a lost decade, right? Like trading as low as like $1,000 halfway through the 2010s. And I was really just left scratching my head, like, what is going on here? And it wasn't until the later 2010s, 2016, 2017, that I looked back into Bitcoin, then lost that Bitcoin, which is a whole other story. So then I put Bitcoin away in my mind until 2020, and we had the massive money printing, and I was like, something needs to be done here. And that's when, thankfully, I found Bitcoin and sort of dedicated my time and energy to it, talking about it. And now here we are. But another correlation that seemed to have broken down this cycle was Bitcoin and M2. And I'm wondering if you had
Mm.
looked into that and what is going on there.
Yeah, I mean, I can pull up just the straight up M2 chart here. I mean, this was, if you remember last year, it was probably one of the hottest charts on all of Bitcoin Twitter. There was fierce debates about, you know, does M2, what is the lag between Bitcoin and M2? Is it 10 weeks or is it 9 weeks or is it 12 weeks? And it was getting extremely precise about how much predictive power M2 had over Bitcoin. Um, some of my most popular videos were analyzing that, but for the most part, it's kind of a bit useless trying to predict it on a sort of like weekly or monthly time basis, because capital takes a long time to trickle into the system and certainly into Bitcoin. Trying to model that is just absolutely crazy. But what you can see here is that we've got two charts here that go pretty much up and to the right at the same time. And the correlation between these two, depending on what sort of delay you give the M2 to trickle down into Bitcoin, it's anywhere between 80 to 90% depending on the time frame. So there's certainly a massive correlation between the two, and there's the whole trade of Bitcoin. The reason you're in Bitcoin is because M2 keeps going into infinity. So there will obviously be a correlation between the price of Bitcoin in US dollars and the US dollars that have been printed. So, but what we can see here is, like you correctly said, is that there's been a bit of a disconnect. We've had M2, it's been actually increasing about 7% year on year right now. So pretty strong growth in the M2 money supply, but Bitcoin has lagged that, and quite significantly. And, for the most part, it has followed it roughly, as I said, not to the month, but it's been in the right general direction. And that's why I kind of do lean quite bullish towards the end of the year, at least, because there's no signs of M2 slowing down right now. And Bitcoin has been dislocated from it for quite a bit of time right now. And it's only a matter of time, as history's shown since the start, that it doesn't take too long for Bitcoin to catch up right now. So, yeah, it's kind of one of my biggest sort of bullish macro theses behind Bitcoin this year, is that it has had that dislocation from M2.
The catch-up trade. But have we ever seen a dislocation like this before? Have we ever seen M2 go up and Bitcoin go down? It doesn't look like it.
No, I mean, you can quite clearly see it on the chart. There's
Yeah.
obviously small periods of it, being slightly dislocated. Like I said, it's not perfect, but no, not to this sort of extent. No, this has been one of the largest dislocations that we've seen, and that is why I definitely remain bullish.
Gotta remain bullish. And if you remain bullish, then you want to keep on accumulating Bitcoin. And one of our favorite ways to do that is with our friends over at Rhino. Getting access to Bitcoin financial services historically has been slow, clunky, and scattered across all these different platforms. But Rhino is solving that. Rhino is a next generation Bitcoin banking app designed to handle all of your Bitcoin needs in one place. Here's what you can do with Rhino. Of course, buy Bitcoin with zero fees, get more sats for every dollar you spend. Make payments over the Lightning Network instantaneously with zero fees as well. Send cash globally, fast and easy over Bitcoin rails to friends or family anywhere on the planet. And of course, set up automatic savings, DCA, so you stack sats on your schedule and build wealth over time. Soon you'll be able to pay bills, direct deposit, and borrow against your Bitcoin, all within the app. And of course, security is a top priority with biometric verification, 24/7 fraud protection, and the confidence of knowing your Bitcoin is never, ever rehypothecated. Go today to rhinobitcoin.com, download the app on either iOS or Android, and use the code Bitcoin News. One word, Bitcoin News. Rhino will drop you $10 in free Bitcoin into your account just for getting started. Shout out to the team at Rhino. They continue to build, doing amazing things over there. New layout coming out very soon. If you have any questions, be sure to hit them up over on X. All right, everybody. I want to take this conversation over to the new entrants really in this market cycle, which were the ETFs and, of course, the treasury companies. Did these institutional buyers change the study of on-chain metrics at all?
Not specifically, no. This is a common question that I get asked quite a lot, is now the introduction of the ETFs, is on-chain analytics dead? And actually, it's quite the opposite, because what we can see here is, so this chart here is the realized capital flow. So in simple terms, this is the amount of dollars that is being pumped into the Bitcoin network or taken out of it on a 30-day trailing basis. So this is the literal capital that is entering or leaving the network. And there's nothing more sort of, it doesn't tell a clearer picture than this one here. And if I just quickly switch on to the next slide here, this is the institutional flow as a percentage of that realized flow. So let me explain it quickly. The green and the red colors here are the total capital flows in and out of Bitcoin. And there are two other lines that you can see on the chart here. In orange, we've got MSTR, so strategy, and that is their total flow, which for the most part has been positive. And the blue one is the ETFs. So this is the total flows of all the ETFs into the Bitcoin market. Now, when I get told that, well, the ETFs and strategy are completely propping up the price or they're destroying all on-chain metrics, well, we can clearly see that that's not the case. At their absolute peaks of their power, we can see during the $100,000 rally in late 24, where strategy was accumulating more than it's ever accumulated in its life, it still didn't even make up 20% of the entire capital flow going into Bitcoin. And that was at the peak of its power. Right now, the total institutional flow into Bitcoin accounts for 1% of all of the flow into or out of Bitcoin, which right now is out because we're in a bearish period. So no, it doesn't really affect the on-chain analytics as such. And if anything, it just gives us another lens to analyze, because now we've got the ETFs, which have behaved completely differently to how the average Bitcoiner behaves. We can see here that this is the total flow of all the ETF money that's flowed into Bitcoin. And although we've, like you correctly said, had about a 50% drawdown in price, the ETFs have only drawn down 18%. So this is another really interesting data point that we just didn't have before, because no one really behaved like this. And, you can say that this is, they estimate, it's kind of hard to estimate, but they say that about between 30 to 40% of the ETFs is institutional and the rest is retail or being managed for retail. So it's hard to say who's causing that and who's not causing that. But it's an interesting dynamic playing out nonetheless, that these have actually been diamond-handed holders and they've just increased the sort of data that we have. It doesn't really alter the existing data that we do have.
Wow, that's an amazing stat you just gave, that at the peak of Strategy's powers, they were only buying 20% of the Bitcoin. I'm sure if you asked the average person, they probably say it was a lot higher than that. Very cool. And now we are seeing some weakness though now with the ETFs, correct? More so, much more so than we've seen in the past.
Yeah, absolutely, we are. I mean, if we just switch back to this chart here, during these sell-offs, the ETFs have actually been major sellers of this sell-off. So during this wick here, we actually had about 20 to 25% of the realized capital outflow coming from the ETFs, which has been unprecedented. Actually, the ETFs only sold off about 3% of their holdings for the most of this bear market drawdown. And it's only been the past 2 months or so where they've actually offloaded about another 13%. So there have been they've transitioned from this, diamond-handed cohort into ones that are really getting flushed out of the market. And this is the most that they've been tested right now. So it's an interesting dynamic. I mean, again, because they've only been around for a couple of years right now, it's hard to say what that truly means. But for me, my own personal interpretation of that is that this is exactly what you wanted to see. You want to see every participant shaken out at the bottom, not yet some of them are shaken out, some of them are still holding strong. You want to see everyone capitulating at the bottom. And it's kind of like what we're seeing right now. We can see that this is another interesting metric that I developed recently, and this is the total institutional flow. So we're talking all the treasury companies, all the sovereigns, all the ETFs, which we're kind of grouping into an institutional bucket right now. And what we can see right now is that anything below this green horizontal line is negative flow. And we've seen the largest negative flow of all institutions. We've seen strategy selling as well, albeit a small amount. Institutions on a whole are at their worst levels that we've seen since the beginning of 2024, where we've had all this reliable data. So yeah, it's interesting to see. I'll be interested to hear what your take on that. But for me, that kind of marks the capitulation that we want to see at these levels.
100% agree with you that seeing the ETFs finally sell is one of my favorite bottom indicators yet. I mean, they've had such an easy ride. They get in around the bottom in 2024, and then they just ride it up from 30K up to 126. Everybody in the Bitcoin market, if you are a long-term holder, you're going to experience some pain. It's the price you pay for entry, and now they're finally feeling it. But still, it's not like the majority of ETFs are selling, right? I mean, BlackRock is still absolutely huge, and they're not going away anytime soon. But it is good to see some weakness. You know, these guys got to feel the pain too. You got to earn your stripes, and now the ETF holders are finally doing it. Yeah, and
Yeah, absolutely. I think it's, they've had a few little tests on the way, these bull drawdowns where they have gone underwater a little bit and they have felt a bit of pain, only for them price to rally again. And like we said, they didn't make up the majority of the realized flow. So they're not the ones dictating here. They're kind of, it's hard to say what's the chicken and the egg in this scenario here, but I believe they're reacting to what the price is doing. And right now, this is the largest unrealized losses that they've been sitting on. If my data is correct, then the average cost basis of the average ETF holder is about $85,000. So they're sitting on, pretty large unrealized losses, and they're eventually capitulating on them. So it was only a matter of time before they got tested.
so I don't want you to give away any of your secrets, but if somebody is interested in diving into on-chain analytics like you do, how do they get started? What data sets do they use? Can you just run a node and get everything off there? How does it work?
Well, yeah, you absolutely can, but I wouldn't advise that for someone that's never, even stepped into the world of on-chain analytics. I mean, the places to start is why I started talking about when I mentioned the whole 2020, 2021 era, is that metrics all basically stem from something called the realized cap. And the realized cap is kind of like the backbone of on-chain analytics. So it essentially looks at every price that each coin has last moved on and aggregates that for the entire network. And all of these metrics that we've been speaking about, for the most part, are all based on that, the unrealized profit and loss of the network, the spending of the network, all of these ones you can start with, MVRV, SOPA. I'd start with the basics first. I wouldn't start throwing in and trying to run your own node and decoding all the data, because you just get your head in a spin. But there's plenty of good YouTube videos out there, not just my own, but there's a lot of early Glassnode videos that I would advise getting into. But you can get down a pretty deep rabbit hole with all of this. But there's, yeah, I'd start with the basics: unrealized profit and loss, realized profit and loss, and just cohort cost basis, and just see how price reacts to those, because it really does react to those quite strongly.
And you've been building and analyzing since before AI really took off. How has AI changed your work in this field?
Well, AI has allowed me to work faster. That's all I can say. Like you said, I was building before AI was a thing. When ChatGPT came out in 2022, it was basically useless compared to what it is now. So it's really not advanced my workflow, apart from nowadays it's allowed me to, build slightly, more visually pleasing metrics. So, it's allowed me to do that slightly quicker. But using AI to base your investing decisions on, or to try and analyze on-chain data, like I have run through my data or charts through AI, and just try to get its perspective on it, see what it's going to come up with. And quite often it's still not got the point of it. It
Mm.
understands what it is, but the whole nuance behind investor behavior, there's a lot of interpretation with on-chain analysis. Technical analysis is very subjective, but on-chain analysis, it's reasonably objective, in the sense that, an unrealized profit or loss for a certain cohort is what it is. Your interpretation of that, yeah, sure, is subjective, but I feel like AI really hasn't grasped that yet. So I'm actually working on something in the background to try and, get AI incorporated onto my platform that can kind of answer the questions. But right now, it really doesn't answer them to my satisfaction. So far, it's been useful, but not a game changer.
That's super interesting. And when it comes to technical analysis, you often hear the term chart crime. Is there on-chain crime? Are people what data is misinterpreted the most?
Oh, yeah. I mean, there's not as much chart crime on chain, because, like I said, it's pretty hard. Like if you look at the realized cap holidays, if you've got a basic understanding of that, it's hard to sort of get that wrong as such. I guess my sort of biggest pet hate with technical analysis in general is trend lines. So you can definitely draw trend lines on charts like this. You could easily draw the trend line here and go, well, that has to happen. Well, clearly a trend line on this chart would have had you missing the top entirely. So I think you can definitely draw some sort of slightly sketchy conclusions from on-chain analysis for sure, but it's definitely harder to do. But I'm not a total technical analysis hater as such. I actually kind of like to incorporate it as part of the overall stack. I mean, one of my favorite ones here is something called the adaptive trend model. And this, for anyone that's done a bit of TA, this is essentially just a smooth average with some ATR, some average true range bands around it. And you can see quite clearly that it's been very effective at calling the trend of Bitcoin over time. And this isn't subjective. It's not me trying to draw 5 different lines on the chart and going, well, it's bounced off this, resistance line 3 times, so therefore it must do this. This just says, look, the trend is breaking down right now, and we're going to have some pretty bearish action. And the same is true with the upside as well. It's been, it's not a 100% hit rate, and you wouldn't bet the whole house on it. But technical analysis still does have its place, and that's kind of why I'm still leaning, cautionally bearish, because as you can see on this adaptive trend model, despite this nice little price action pump that we've had, the trend is still very much downwards until proven otherwise. So yeah, I think things have its place, but when you start drawing random lines onto a chart, that's where I start, disconnecting a little bit.
And one thing that I gave you kudos for in the beginning is your aesthetics. It's so important to display this information in a way that is easy to understand, and I think the way that you do it, the way it looks, is unique and powerful. How did you get this aesthetic for your site?
Yeah, I mean, through trial and error. If you were around in the early days of the site, you'd be saying a completely different ball game, where I was just trying to get metrics onto the board, and they didn't look aesthetically pleasing. But now we've established the frameworks that we think have worked best. We can now refine them so that they tell the whole point of something being aesthetically pleasing is not just because it looks pretty, but because it can tell you something quicker than a complicated chart can. So, for instance, if we go on to this chart here. Now, this here looks actually quite deceptively simple. It's something called paper versus confession, and it's the 2 metrics that I've spoken about quite a bit in this stream, which is the MVRV, which is the unrealized profit and loss, and the SOPA, which is the realized profit and loss. So essentially, the paper you're sitting on and the confession that you've made. Now, these are quite complicated concepts for the average person, and you could get all sorts of muddled up in the charts themselves. But here I've tried to just color code it by what people are doing on paper and what people are feeling on paper and what they're actually doing about it, the confession. If we zoom in here, we've got these we've got these different color coded bands here, and it kind of just shows you at a glance what people are feeling. So right now we're actually in a phase that I'm calling the shakeout phase. This is this purple phase, and this kind of happens when people are still sitting on reasonable profits on paper, but for the most part, there's still a lot of loss realization going on, and there's quite a lot of different nuanced concepts in here. But essentially, like I believe the best data is the one where you can look at it, and within 5 minutes you go, I know exactly where we are right now, and you can make up your mind with what you want to do with that. These different phases here. We've got the green, which is the growth phase. We've got the purple, which is the euphoria phase. And we've got the red, which is the capitulation phase. I like simple data, taking something that's complex and make it just simple to interpret.
I don't see that much euphoria on this chart.
No. I mean, the purple is the euphoria. So
Yeah.
we did get some spikes of euphoria. The yellow is the wait, hold on, am I getting that? Yeah, I'm getting that correct. Purple is euphoria. Yellow is distribution. So it's sort of increased profit taking, increased paper gains. And the euphoria is the extreme sort of distribution that you see during the cycle tops. The one interesting point that I think we haven't seen is the capitulation, which we saw right at the bottom of the previous cycle and during the huge sell-off that happened just before that. And again, we saw it in the cycle before that as well. Now, the only reason that this isn't flipping red is because the average Bitcoin holder is still in profit, and that's the MVRV. So the average Bitcoin holder paid about $53,000 for their Bitcoin, and that's the average across the entire network. So if we dipped below that level, we would then fall into the red, because actually people are selling at losses, but the average Bitcoin holder is still slightly, sitting on a modest profit.
Well, Tom, we are coming to the conclusion of our time here, but I want to leave the viewers with something actionable. If you have a checklist, 3 things to look for to mark the bottom, what would you say those 3 things are?
That's a very, very good question. I mean, straight away, I've got to come back to this Omega score here. The below 10% risk levels. This is an accumulation of dozens of different metrics. That's one that I'm keeping an eye on almost every day. That's something that just is a non-negotiable for me. One that I haven't mentioned today, which I think is quite interesting, is risk-adjusted returns. This is another one that I keep on my radar consistently. Now, if all this on-chain analysis has just scrambled your head, then you'll probably understand this one a lot better. This one here is an amalgamation of the Sharpe ratio, the Sortino ratio, and the Karma ratio, which are all risk-adjusted metrics from traditional finance. And basically, what all of them tell you in varying degrees is how much return you're getting per the unit of pain that you're feeling, essentially. So this is another one that I'm looking for to mark a bottom. And as you can see right now, when the risk-adjusted returns are dipping right down into these lower percentiles here, that's when the best risk-adjusted returns have been generated going forward. And again, we're sort of not on the turn right now, but we're right at the bottom. So I don't like to time perfection. I like to be in the general zone, and we're in that general zone right now. So those are the 2 that I like to keep an eye on a daily basis. I don't think you need much else, to be honest.
Well, there you have it. And you can find these charts on your site.
Absolutely. Yeah. All of them are on there. We're currently running a 7-day free trial for all premium members. So you can go and try every chart on the site for free for 7 days. We have a lot of charts that are just free in general for everyone to have a look at. So yeah, go check it out if you're interested. We've got guides on there. If this all feels a bit too overwhelming, we've got tours that walk you through it. So all of this probably seems quite overwhelming, but we try and at least say hold your hand through the process.
That's amazing. You've built something very, very cool here, and not only cool, but useful. So I appreciate you and your contributions to the Bitcoin ecosystem. Everybody check out Tom. He's On-Chain Mind on X, and you can find his website. Same thing, right? OnChainMind.
Yes. Yeah, that's the one. Yeah. Yeah, that's the one.
All right. Well, thank you so much for tuning in, everyone. If you've enjoyed the stream, share it, repost it on X, hit like on YouTube, share it with a friend, give them some perspective on where we are in this bear market. It might not be completely over yet, but a lot of the signs are there. Thank you so much for tuning in. This has been Rob and Tom. Until next time, we'll see you live.